Another exciting episode of Hedge Heads brought to you by American Federal Bank. John, what are we discussing today?
Hey, Christmas episode. Why are you buying the options that you're buying? So if you ever wanted to hear a breakdown of how to decide what option to buy in what time frame, and you're just a little more interested in how those choices get made, this is the episode for you. We're going to talk a lot about that. We're definitely going to hit crude oil and whether we should be filling up our gas tanks. And we'll touch on cattle a little bit, but this is going to be an option episode spectacular.
Are you going to sing us any Christmas carols?
No.
Welcome to Hedge Heads, where hosts John Prischmann and Ryan Tungseth discuss commodity markets, hedging, and anything related to trading futures. Remember, the risk of loss in trading commodity interests can be substantial. These are opinions only and not trading advice. While no one knows where the market's going, they're not afraid to share some ideas.
Well, John, Merry Christmas, since most people will be listening to this on Christmas Eve, Christmas Day.
Yeah, and the markets, they're open tomorrow. It's kind of crazy, but that's the way it always is. And then they're open again the 26th, though. 25th we're off, but it is what it is. The markets feel like holiday markets. A lot of times people think that they're going to trade like holiday markets, and they actually have plenty of action and some opportunity. This year is full holiday mode. It's like watching paint dry, but it's a good time to talk about what I think is a really important thing that a lot of people don't discuss is how do you pick what option in what time frame, and what are some of the the benefits of shorter versus longer, and for grains, why months are really important. I think that's a good time to talk about it. Also, we have the oil market making an interesting move. We'll touch on that, and we do have plenty to talk about. But again, let's break down why and what option you buy when and in what kind of markets.
Sounds good. What are we starting with? Corn, or are you talking grains in general?
Yeah, we'll go.
What do you want to do?
We'll go with grains because they have defined time periods that you want to look at, and a lot of guys want to dive into options and they want to pay the least amount of money. They think that's the safest. It's the safest for your bottom line, but is it the best to do? It really depends on the time period. Like, look at the time of year that we're at right now. We're in front of the South American weather, although I would say we're about halfway through. And then we have our planting weather, and then we have our growing weather. So if you're buying, let's say, March, right off the bat, you're looking at a March call. You're thinking, well, what's the least amount of time, or what's the cheapest? You're not usually going for the least amount of time. You're just going for it's always the price. But so you look at something up front and it's like 11 cents and you think, wow, that's pretty reasonable. But what do you get for this 11 cents? You get the South American weather and barely all of that. You get the third week in February. So if you have a soybean or a corn option, you're looking for more of a fundamental move than you are, or a weather move than you are anything else. So in my opinion, March, with the way weather's going in South America, it's a poor option this time of year. People get mistaken with fronting money, and then in between fronting money and then paying a certain amount of money for an option. Meaning, let's say I look at the September time frame. For a 470, you get, for 22 cents, you get this entire time frame that I was talking about. In addition, you have our U.S. planting weather and our weather. So the chances to bring this option down to nothing or very cheap in front of a summer are virtually nil. So what you're looking at is, like, you got 11 cents risk in the March call that you're buying up front versus the 22 cents in the September. In my mind, you get much more value for the September, even though you're fronting the 22 cents. You're coming up with more out of pocket. What happens if we get to the third week in February and the price hasn't moved? Well, your March call is most likely worthless. It's zero. You get 0 cents for that option and you're out of the game. Where you look over at the September option, and in this entire time period, September's probably come down, and we can't know the exact numbers. But in front of a summer, in the third week in February, with the entire growing season ahead, and the price is near unchanged to where we are today, you're probably looking at 17, 18 cents. So you have a 4 cents hypothetical loss there. So you lost 11 cents on the March, and you've lost 4 cents on the September. So you see the big difference in when a year's set up like this, without a lot of volatility, the what they would call theta has bled out of all the time value has bled out of the March because we haven't gone anywhere, where September has spring and summer weather and a lot more time. So yes, you've gone backwards, say even 6 cents, but you've gone backwards 11 cents in the other one and you're out of the game. So that's why I tend to favor the longer term ones over the shorter term. Now, what could happen though, if this is more bullish than what it looks like and all of a sudden things change really quick and the front goes up much faster than the back end. Say March goes up 40 more cents in September, which is exactly what happened last year. You would have been much better off in the shorter term, March short term one. So my point is that you got to really break down what kind of market that you're looking at. Are you looking at one that could really start moving fast in a shorter time frame? Obviously, short-term ones are good. If you're just trying to be a part of the market because you think it could go up, but it doesn't have a lot going on, like our corn market. You got some good news, some bad news, plenty of corn around. You're going to want to go longer term. So you always want to break down what time frame you want and why you're buying this. And to tie it back to what we're doing, you'll have guys call in and say, "Hey, I sold these bushels and I want to cover it." And again, the first instinct is to go after the cheap one. I'm going to go with the one that's the least amount of money. They don't even consider the other ones just because they're just solely looking at the money. They want to cover these bushels. Then I ask them, what are you going to cover? Were you planning on storing it maybe till spring or summer even? Well, maybe. I don't know. I'm selling it, but, I just want to cover something. They just keep kind of circling back. And then they always gravitate towards the cheapest one. So in my opinion, that's not the way to go about it all. What's your goal with this? Were you going to hold it to see what the South American weather did and then what our spring weather did? Or were you never planning on holding this very long and you just want to sell it and you just want to kind of have, a foot in the door a little bit, and that's why you're going the cheaper? Know why you're buying what when you're buying it. I mean, it's just you got to know what your goals are when you're purchasing these. Otherwise, you're going to waste a lot of money on options.
Yeah, I think the most important thing is knowing your goals, because I'll approach it from a completely different angle than you just talked about, in that I talked about this Thursday on our Insider episode, but I had bought some 440 January calls, 8 days.
Yes.
Right? I mean, when I bought them, they had 8 days. But I had looked at the March 470s. They were the same, 470s. They were the same price, right around 4 cents.
Yeah.
The 440 December, 4 cents was 2 cents in the money. Very close to the actual price, right? The March 470, well outside the money, 30 cents out of the money at the time.
Yep.
For 4 cents. I chose to go with those Januaries with only 8 days because I only wanted to hold through the weekend.
Yes.
Right? And so, like you talked about, that front month can move way faster.
Yes.
In this case, it's based off the same contract, so the month didn't move, but being much closer to the money makes way more difference, because all of a sudden that 440 was 8 cents in the money rather than 2 cents. Now, you have the same risk, but you have the time frame now. Obviously, corn could keep going up, and it could be 480 by March, and I might have made more doing the other one.
Yes.
But my time frame was I wanted to see what happened through the weekend.
Yeah, you had a large sell-off going into it. You had a very short time frame. It's likely to bounce. And your goal was speculative, and you were trying to make some money in very short periods of time.
Yep.
We're actually going to have that situation coming up here very soon for the grains. We have a big January report coming. And you're going to have options that have, February options. You're going to have very few days on this stuff, or even the March. And you're going to have a chance to buy these short term. And in that instance, your goal would be to cover stuff or get involved on the speculative side of something you think is going to move the market a lot, which would be this report. So, and then that's another thing. Like sometimes shorter term calls can be good in the fall, when you have what you think, what could be explosive reports. But we've kind of got through that, and we haven't had that. But we are headed to January, and because of the government close down, this is going to be a perfect report to, like, you can look at, straddles, you can look at strangles, you can, by both sides. When you got a report they think is going to be volatile, you can use short-term stuff to very good results. I mean, assuming that you're on the right side. But it's that volatility in that short term that really helps you. If you can pick those windows where it really picks up, that can really help you. But really quick, for the USDA reports, it's been so long since we've had these explosive reports, we haven't even talked about these strategies. But it wasn't that long ago that you'd have these USDA reports, and then you're buying these really short-term options, and it's almost like an insurance policy to get you through the report. Meaning you're sitting on all these bushels, but if it's a high yield, it's going to send it down sharply, and you just want that 2-week protection. There's a lot of times there's 14 days on these. So they're very good for that. But back to what Ryan was saying, just know what your goal is, and that's where I began on this. What is your goal? And a lot of these guys that were calling in, they wanted to re-own this, but they only kind of wanted to half re-own it, like real half-hearted and not saving a lot of money. And that's a defensive way to kind of own it. Like they're already on their back heels. They don't want to spend very much. They're not very hopeful. It's like you're almost better off skipping it, or in my opinion, you're a lot better off going with a long-term option and seeing what's going on, especially in a year like this when you had 99 million acres of corn. But again, other years where you want to be upfront, you shouldn't know all this. You might be confused by some of this talk, or maybe all of it. Maybe you really know what we're talking about. But that's why we're here. This is exactly what we would be doing, breaking it down with you on the phone, why you're doing what you're doing and what time frame. And then, of course, it changes all the time. You have implied volatility, and things are constantly on the move. And what looks like a great idea one day, 3 days later, it's a terrible idea. And that's why we love the commodity markets. I mean, it's just something that's always on the move. But back to where we started again. Know why you're buying what option and what time frame will save you a lot of money. Because you keep hearing, all these options expire worthless, 90 expire worthless, out of the money, all this stuff. There's just thousands upon tens of thousands of options and strike prices, and it gets to be very confusing what to do when. And then you factor in spreads where, like in feeder cattle, January was way ahead of March, and that's not normal. So it would have been better in buying in March. And then if you had to, it needed more time, then looking at, April later on and divided two. Anyways, without getting too complicated, you really want to break down what you're doing. Otherwise, the sayings are right. You're going to lose money in options if you're just kind of firing it out there and not really thinking it through. Specific time frames and specific time of year and implied volatility and going into implied volatility all has to do with that. And it makes it sound complicated, but it's not when you start breaking it down and knowing what your goals are. Do I want to know longer term, shorter term? And that's why I favored the September side of stuff this year.
Yeah. I think an important note on the percentage of options that expire worthless. Don't hold your options till they expire.
Yeah.
I mean, you do not have to hold an option for any amount of time. If it's not working, get out. If it is working, get out before it's not. I mean, that is the hardest part, is choosing when to take profits.
Yeah.
But you don't have to hold it till expiration, and that's one of the biggest advantages to options, in my opinion. I know you love the September. I prefer the July. When we're looking at the summer, you've told your story many times on why, but you can always roll those Julys to September too.
You can.
And
people don't like
options.
Doing that, though.
No, I know, because it costs money.
Yeah.
But if it's not happening by July and you still think, or end of June, really, the July options expire the last week of June, you can, if you still think whatever it is going to happen.
Like the 2012 drought.
Like the 2012 drought. You could have gone and bought a whole bunch of September calls, John.
Yeah, I was there.
You could have gone and done that, and you chose not to. And that's this psychology does factor into that when you already own some others that aren't working.
Yeah, it's always harder once one expires just to buy another one right in a row, just for anybody. Just seems like you've just thrown money away and now you're throwing more money away. So psychologically, it's really difficult to do that because you feel wrong. Like, why would I be double wrong? But it works for all markets. And then if you get really good at it, in recognizing like time frames, like you just saw it in corn where it was a great setup. Short-term options can be a wonderful tool. Again, I just like to cast a wide net. I'm a longer-term option guy, or oftentimes I am, even though it costs more. But you really just got to know what you're looking at, when and why. For options, and it helps with having a guy there. Also, guys, like you said earlier, you don't have to stay in the whole time. And not only that, I encourage you not to. The old mentality was, this is a hedge, I'm going to keep it on, and the whole time. It's like, you don't have to do that way, and you're going to find your highs and lows in these options. Almost, I don't have a exact percentage, but a very high percentage of the time, nowhere near the beginning or the end of these options. Like, you're going to find the highs and lows in the middle, or at the beginning, somewhat in the beginning or somewhat towards the end, but they're very rarely just like right on the exact dates. Guys buy them and kind of walk away and forget about them. And at one point they were probably up money. And recently there was guys with bean calls on that were worth quite a bit of money, and now they're at a loss. So it's, getting out, it tends to be the hardest things with options. But still, next time you buy an option, think hard and long why you're buying this option and why this time period. Why am I choosing this? If you're solely choosing it because of the amount that you're going to pay for it, you're going to have a hard time trading options. Just because you pay $2,000 for an option doesn't mean that you have $2,000 at risk. Theoretically, you do, but it's not going to go to zero overnight. You could say, "Hey, I'm buying this $2,000 option. It's a what I want, but it's too expensive. I'm willing to risk $1,000 in this." You can have your mental stop losses. You don't have to stick around for the whole thing. And if you sell options, one of the most important, this is a whole nother episode actually. If you're option sellers, you don't have to get 100% of this the premium either. As a matter of fact, that is very dangerous to do. Let's say you sell an option for 20, 30 cents. Have it in your mind, I'm going to get 80% of this options value out of there, and then I'm going to get out. Especially when you have 3-4 months and you have nothing but risk and you can gain very little. That's a whole nother episode, so we won't get into the short option stuff. This is long option only, and kind of trying to help guys maybe why they've had a lot of trouble in the past, because you do hear that a lot, is I didn't make money on options. And when I hear that, I really think that it's either them chasing markets like beans after it's moved, or they're buying corn calls. I'll give them that one. The corn calls, just for the way they're priced, they're very hard to make money on.
It's really hard to make money.
And
the other market we're going to talk about today, crude oil.
Yeah,
there's another option, but those two option markets are hard to make money.
Yeah, it's in that the reason is because the premiums are so high. It doesn't seem like the premium's high in corn, but it is in relation to what that market can move. Where the oil market can move it like a ton at any time, but often doesn't. They tend to be really overpriced, for a different reason. They do move, but the way they price the premiums, so they tend to be markets that are better for selling. But yeah, over the crude oil market quickly.
Before you jump there, I just want to back on grain options, like from a psychology standpoint, and going back to talking about time frames is. I have been looking at or bought and pricing soybean options. I would not have done those short term.
Yep.
Those I have looked only in the longer term, and that's because of the time frame. When do you expect a change?
Yeah.
And so those, you need to know like why you would buy something first, right? Just like anything else you would go out and purchase.
Yep.
Why would you buy it? And then two, when is that likely to have whatever you expect to happen, whether that's market going up or down? What's the time frame you would expect whatever would cause that to happen? That's where you have to look. And then it becomes a price thing.
Yeah.
Right. And maybe you just can't afford them. I have plenty of options I'd love to buy that I'm not going to spend 40 cents on that option, even though I think it'd be a great, I'd love to have some 1060 bean calls right now. I'm not spending 45 cents for them.
Yeah, and it's hard to with what's going on. But there hasn't been very many markets that it's been working. Long options have been working very well in. Beans have been long puts and calls. Of course, timing is everything there. Both sides it's moved plenty on both sides for money to be made there. Corn, not really. Corn's kind of dead in the water. So you say, why don't we sell options? Well, the implied volatility is so low. Sometimes you just leave a market alone. If you're sticking your feet in the water, I'm longer term looking for. My goal is to see a lot of weather. I don't expect it to explode right now, but we could see a lot of weather. I also, like last episode, I think there's a little more going on with corn than meets the eye. We're not quite there to call it bullish, but it's certainly able to rally, but it's got a huge anchor. Wheat, I noticed that spread got down below 80 cents between wheat and corn. And then beans.
And for good reason.
Yeah. Wheat's bearish. A spread that we had on is the Kansas versus Chicago. It was 15 cents under. It actually got to 19 cents under. And now I noticed today it's 11 cents under or over. And I'm long gone out of that one. But, there's been some inner wheat spreads moving. But the grains really kind of are going back to sleep here. It's getting to be a little tough. So let's move over to crude oil, where there could be opportunity. I wanted to talk about crude really quick for a couple of reasons. A lot of guys are calling and wondering whether to lock it in or, is this the time of year? And I think everybody knows this feeling. Winter, it goes down, and you just know by spring and summer it isn't going to be here. So everybody gets a little itchy this time of year, and you can't blame them. So you look at the seasonals, yes, it does favor the upside. But then you hear the news stories, and you see the crude oil price action. It's going down every day. Today, I think it bounced a little bit, but what are we, 54, 55 bucks, somewhere in there?
Yeah, well, 58 in the front, but
yeah, and
it was only up 30 cents or so.
Yeah, and it got down to 55, so it's as weak as it's been in years, and everybody's like, why? Well, the funds are selling, call it algos, whatever you want, and you got a unique structure. What's fascinating about this market is generally, if there's an oversupply, the price goes down, and that's what the funds have been saying is going on. There's going to be this gigantic oversupply, and they're thinking that it's going to hit by mid-2026, and it's going to be like the negative $50 oil again. But what's interesting is we're not there yet, actually. The fundamentals don't fit the price action, and the spreads are telling you that. Back to the spreads. You look at the February over the March crude oil, and the difference is February is 25 cents more. Does that look like a glut market? It does not. So maybe it's just a front thing. No, and then you look at March, April, that's also inverted. And then you can go on down the list. You don't have any carry in this market, and it's a very unique setup. So what you have is a market here that says, I'm going to be bearish, or at least the funds say that, and they made this gigantic bet on the short side. Meanwhile, the fundamentals aren't bearish. And you're showing inversions, meaning like we bring that oil here, we'll pay the most. If you store it, you're going to get less. So when market gets inverted, it shows that the commercial side of stuff, they need the oil. Of course, that can switch fast, but it's unique as normally you wouldn't see that on the way down, and especially at this time of year. There's some very good seasonals on crude oil spreads that I have clients do pretty much every year, right, going into Thanksgiving and after. This year, they were put on. They worked a little bit, but they didn't work as oil went down. So it's been a kind of a confusing time. So is there opportunity? Is it a good time to fill up? When you look at the spreads and you look at everything going on there in the physical market, I would say, yeah, this would be, you're looking at probably an opportunity to get stuff on. Other guys will disagree, of course, and say it's going to go down. But I'm talking on the cash side of stuff, not on the future side of stuff. Should you start filling some tanks? I think common sense says yes, but what I wanted to point out with crude oil is the structure of it and how interesting it is being in an inverted market on the way down. Those can turn into very strong bull markets, especially if they're pushed the wrong way for too long. And then with the story that they have, this glut forming in 2026 doesn't come true, then you end up getting explosive bull markets. So how does that tie into the farm? Exactly what I was saying. It's if they're not right with this glut going into 2026, you're going to see substantially higher oil prices coming into next year. Now, they could be right in the glut. The futures right now are saying they're not, even though their selling's been overwhelming and it's driven the futures price down. The physical market does not. It's a different structure than you would see if there was a glut around. So it's not here yet. And then back to the cash diesel side of stuff. I would be looking for areas around here to get stuff filled up. And that's just what I would do if I was looking on the physical side of stuff.
I have a few notes on the crude oil market just in general.
Yes.
One, know when reports are because they're weekly or near weekly, and they move the market.
Yeah.
They really do move those markets. Two, the micros are super effective. I don't like the micros and grains.
Yeah,
there's not enough action. There's not enough movement. There's not enough benefit to them.
100 bushels.
100 bushels is insane.
Yeah, it is.
But the micro and crude oil is a wonderful contract to learn how the market moves. If you just want to speculate, trade crude oil, the micro crude oil contract, go either way. Whatever your fancy is, it's a great contract to learn with.
It is.
I mean, it's still obviously there's danger.
Yeah, you're going to feel if you're wrong. You're going even in the micro, it's only 10 barrels. You're still going to feel if you're wrong in that. It's not going to be painless. Where I don't even know how you get a micro grain contract if I put one on, I'd forget about it probably until it was expired.
Back when I first started working here, John, the micro wheat contract could be very adventurous.
The mini.
The mini wheat contract. Yes, the mini wheat contract was a whole lot of fun. And so now they're kind of boring.
The bean one is too. The bean one can be. So that's what's confusing. You have a micro.
Is what I was referring to in grains, but yeah.
Yeah, you have a micro, which is brand new in grains. They didn't have, which I think's completely unnecessary. I guess the 100 bushel farmer would disagree with me. He thinks it's a very good hedging tool. So you have 3 different size contracts, and that's what's getting a little confusing about all this. And now you have your micro and crude oil too, and you have a mini and crude oil, and then you have the big contract. So 1,000 barrels, 500, and then 10. I think, unless I could be wrong on the mini or the micro size on crude, but I'm pretty sure it's 10 barrels. And then you have micro gold. You're starting to get these micro contracts. Still looking for the micro unleaded personally, because I want to hedge my unleaded.
Just for fishing tournaments?
For fishing tournaments, driving around in the summer, I want to hedge my unleaded. But unfortunately, that's still, I don't think, a liquid thing. It might even exist, but I don't think that any of that's liquid.
I guess if that's the case, I'm waiting for it in the T-note then, so I can...
Oh, for interest rates?
Yeah.
Yeah, I mean, it's like if you want to start learning about markets, micros are a great way to get in there. And if you have your money on it, you tend to absorb the knowledge a lot faster than just trying to follow it. But so you can. It's a good, like you started with. The micro is a good way to get involved in crude oil. Now, what's surprising to me though on crude oil is none of my clients have called really and said, "Hey, when are we going to buy crude?" Which on every crude break in the past, guys are kind of kicking the tires and looking at crude oil, and not one guy's mentioned it except for asking about the on-farm fill-ups and, just in the physical side of the market. But generally speaking, when you get down here, you have guys interested in the crude oil market. I'm just not seeing that. Whether everybody's betting on sports betting or, cryptos, I don't know. But back when it used to go to $50, you get phone calls.
I got to get my lineup in for the Wild game tonight here. Just a minute.
You better get your 5-legged bet in there that they're not going to pay you on if you win.
Sorry, I distracted you.
No, it's interesting, but it's.
The other thing with the micros is you can spread trade with the micros.
Yeah.
If you want to spread oil, I mean, if you want to use the minis in grain, you can learn how to do spreads with the minis in grain too. But you can trade those spreads, which I wouldn't do it in the grains. But I have done it with the micro and crude oil because some of these things, like you're pointing out, the February being 25 cents over March, there's.
You get enough movement.
There could be opportunity there.
Yeah, you can get enough movement. I mean, it's not going to be a lot. It's the micros, I think, are great for learning.
I've used them in December spreads where there's more movement, not necessarily month to month spreads.
Yeah, when you're trying to get the feel of stuff, micros and playing around the micros are a very good idea. It's very real money. It's not like it's not. But it still gives you the general concept of how the market flows and when you have a little bit of money on it and it pays until you're really comfortable with that market. And of course the regular contracts are what everybody's going to use. Although I shouldn't say that. In the crude oil, half size contract's still very popular.
But the full size contract, you better have some deep pockets.
Yeah. I mean, you're gonna see thousands dollars moving in a day, and that's just the way it is in the big contract. And then, but what really makes the big contract dangerous is that something can happen in the world, and if you're short, I mean, it can go up quite a bit on you, virtually overnight. But everyone knows that in energies, and the energy traders are usually pretty well versed in the risk, associated with those markets. But overall, I just, where we started was with the options. Hopefully that was helpful. I mean, I think it was a good discussion. Hopefully it didn't get overcomplicated. It wasn't meant to be. It was just meant to be, kind of giving you a framework with why we pick the options that we pick. And then quickly, we should probably go over cattle. Again, if you're looking at buying cattle, I mean, go look at the 2015 chart and really study that. I'm not saying that's what's going to happen, but it really burned a lot of people that year. Getting back in there on those bounces after the bull market fell over. It bounced back very sharply from very low levels, very, very similar to what's happening right now. And they kind of study that. But what I worry about is the border opening. So if you don't have coverage, I'd really consider at least pricing stuff and seeing if the numbers work for you, because I do worry about the cattle market. Other guys are going to disagree and say the fundamentals are there, but bull markets, it's an old bull market, and there's a lot more risk than there was in the past. It's had a nice bounce here. So I would recommend at least pricing hedges and seeing if it works for your numbers, and that's kind of how I feel about cattle. I'm not cheering for it to go down, but a guy's got to be realistic here. The government's involved. They're trying to get the beef price down. You're getting plant closures. All that's kind of been dismissed. Pretty soon you're going to have the border open, and it's kind of starting to swim upstream a little bit more than it had been in the past. But then you'll get guys saying, that's wrong, and it's going to go to new all-time highs, and you'll see, and you'll get that in any bull market, though.
I mean, the cattle on feed report, that was just last Friday, right?
Yeah, it was supportive.
Yeah, I mean, that was, I thought, very bullish. Now, where, how does that drive price and stuff? But it was definitely a supportive report. So the numbers, I don't know how that affects.
The numbers aren't increasing yet, and that's kind of what it showed. The placements aren't, but, every day that passes, like I say, the imports are on their way, and none of this stuff I'm cheering for. The government said they're going to do it, and they will do it, and that's where I'm at on it. Is I don't think that they're going to back off this whole deal. I don't think they want to hurt the beef producer, but if box beef isn't going higher, I have a hard time believing cash is going to go a lot higher for any length of time. But we are in a very good 5-week seasonal window right here. So the fundamentals and the seasonals definitely favor cattle right now.
Makes sense. But go check out 2015.
Yeah, do look at that 2015 chart, and you'll see what I'm talking about. You need to be cautious, because if there was a year that feeder guys talk about getting burned in, or cattle guys, it's that year. 2014 into 15 is where a lot of pain happened.
Next thing you're going to tell me to go look at a 2012 corn chart.
Yeah, it's one should study. I'm leaning towards, here's what what is it? It's only December. I shouldn't say this early, but I'm leaning towards the weather not being perfectly cooperative this year. I'm not starting the drought talk yet. It's too early for even Twitter to even start talking about it. But in 4 weeks, 5 weeks from now, they will. But one of these years, and we've been in a pretty wet cycle, or wet-ish. I just think that there's going to be a crop scare this year. That's kind of my call. We're not into the new year. But
that's going to be your New Year prediction.
That's going to be.
We record a New Year episode.
That's a preview to my prediction. Yeah, I like it. I just don't like how everybody's so comfortable with marketing all this grain way out there in December 26th. I've heard December 27.
I've had a few guys asking 27.
Yeah, and you haven't heard any of this talk over the last few years, or very little, and now there's a lot. And markets tend to do what the most participants, tends to go the other way, than where everybody's leaning. Not that everybody's wrong. I'm just, I'll never fault the guy for locking in a profit, but it just seems early to be taking that upside out to me. It seems way too early, but you never know with the markets.
Yeah, I mean, I would never disagree with you on that, and just because the weather across the world last year was so, there were very little scary. I know there were a few areas here, and there are a few area. But for the most part, the weather was spectacular across the world last year.
Yep, everybody's
The
getting
year
really.
before that, it was good to very good across the world. Like at some point, just the law of averages says there's something that happens.
Yeah, and that's nothing that you can't just trade on that. But
you can't.
But it I think that the market's gotten very complacent with these just stellar yields and everything going the right way. And you're going to get tripped up. It might not be a disaster drought. What if it's like 171? With the amount of demand we have on corn right now, that it would be a completely different market. And everybody's assuming it's going to stay in these 180s. And who would have thought I'd be talking like this? But I just have that feeling this is the year. And I'm hoping we can come back to this episode and highlight it, on the feeling anyway.
There we go. We wrapped up Christmas and New Year's in one episode, John. We don't need to record next week.
Yeah. Well, we got a great guest coming on next week, don't we?
We do, yeah. Thanks for bringing that up. Yeah, Theta Farmer is going to be on next week. I don't know what we're chatting about yet. I gotta he owes me a beer right now, so I better go.
I owe you beer. He owes you a beer. Back
December.
Back by popular demand. I'm surprised he's still here. I thought he'd be in Fiji right now on a nice beach somewhere, but he's around here some in the winter, I guess.
He told me instead of that beer that I should buy some land and he'd rent it from me.
Yeah. He's turned into a land baron lately. Yeah, I know.
I guess.
But yeah, we look forward to the next time talking with old Theta.
It should be good. Looking forward to it. All right, John, why don't you leave your number?
218-731-1578.
Merry Christmas.
Merry Christmas.